If you have money sitting in a savings account right now, the Fed already wrote you off. Not accidentally, not as a side effect, as policy. Every recession since 2008 has followed the exact same script. The people who own assets get richer. The people who earn a paycheck get left behind. And it's not because the rich are smarter. It's because the system was built to work that way. In this video, I'm going to show you exactly how the Federal Reserve decides, years in advance, who wins and who loses in the next downturn, who the winners will be in 2026, and what you can still do about it before the decision becomes permanent. Part 2. How the Fed actually works. To understand who wins, you first need to understand what the Fed is actually doing when it manages the economy. The Federal Reserve has two main levers: interest rates and the money supply. When the economy slows down, the Fed cuts interest rates. That makes borrowing cheaper. In theory, cheaper borrowing means businesses expand, people spend, and the economy recovers. But here's the part most people never think about. Cheap money doesn't go everywhere equally. It flows first into the hands of people who already have collateral. Banks, corporations, real estate investors, private equity funds. People who can walk into a bank and borrow millions against assets they already own. It does not flow into the hands of a warehouse worker or a nurse or a barista. They don't get a call from their bank offering them a cheap loan to buy up discounted assets during a downturn. So when the Fed cuts rates or prints money, which is what quantitative easing actually is, it's not neutral. It's a transfer mechanism. It moves purchasing power from savers to borrowers, from wage earners to asset owners. This is not a conspiracy theory. This is documented economics. The Fed's own research has shown that expansionary monetary policy disproportionately boosts the value of financial assets, stocks, bonds, real estate, faster than it boosts wages. Wages are sticky. Asset prices are not. That gap is where fortunes are made and lost. Now let's bring this into today. Heading into 2026, the U.S. economy is walking a tightrope. Inflation has cooled from its 2022 highs, but it hasn't disappeared. Consumer debt, credit cards, auto loans, is at record levels. And the labor market, while still standing, is showing cracks in hiring, especially for entry-level and white-collar roles. This is the exact environment where the Fed has historically stepped in. When a recession signal flashes, rising unemployment, slowing GDP, a stock market drop, the Fed's playbook is almost always the same. Cut rates, inject liquidity, sometimes directly bail out large institutions. We saw it in 2008 with the banks. We saw it in 2020 with corporate bond purchases during COVID. Small businesses got a PPP loan application. Large corporations got direct access to Fed lending facilities that bought their debt at scale. Same recession. Two completely different levels of rescue. And here's the part that should genuinely worry you. The people who already own stocks, real estate, or private business equity don't need to predict the recession. They just need to survive it. Because when the Fed responds with cheap money, asset prices don't just recover. They usually overshoot the pre-crash highs. Look at the S&P 500 after 2008. Look at housing prices after 2020. In both cases, the people who held assets through the crash didn't just recover their losses. They came out significantly wealthier than before the crisis even started. The recession wasn't a disaster for them. It was a buying opportunity engineered by policy. Part 4. The reveal. Who gets rich? So who actually gets rich in the next recession? Anyone who owns hard assets before the Fed's next rescue package hits. That's stocks. That's real estate. That's private equity and business ownership. Not necessarily because these people are geniuses, but because they're positioned to catch the wave of cheap debt and asset reinflation the moment the Fed reacts. Let's make this concrete with what's happening right now, in 2026. Example 1. Institutional real estate. Large real estate investment trusts and private equity real estate funds have been sitting on enormous amounts of dry powder, cash raised from investors, waiting to deploy. Their entire strategy is patience. Wait for a downturn to pressure smaller landlords and over-leveraged homeowners into distressed sales. Then buy at a discount using access to institutional credit lines that an individual buyer simply doesn't have. When the Fed eventually eases policy again, these portfolios don't just recover. They get revalued upward, often faster than the broader housing market, because they were acquired below market price in the first place. Example 2. Equity markets and buybacks. When rates get cut, corporations refinance debt cheaply and often use that cheap capital to buy back their own stock. Stock buybacks reduce the number of shares available, which mechanically pushes the stock price up, even if the underlying business hasn't grown. Who owns the majority of stocks? Not the median household. The wealthiest 10% of Americans own the overwhelming majority of stock market wealth. So when cheap money inflates stock prices, that wealth concentrates further into hands that were already positioned in the market. This is the mechanism. It's not that the Fed sits in a room and picks individual winners by name. It's that the structure of monetary policy rewards asset ownership by design, and asset ownership is already unevenly distributed before the recession even begins. The decision about who gets rich isn't made during the recession. It's made in the years before it, based on who already owns something and who doesn't. Part 5. Who loses? The other 90%. Now let's talk about the other side. Because for every winner in this system, there's a much larger group quietly losing ground. Savers. If your money sits in a savings account, you're earning an interest rate that historically trails inflation over time. Even in periods where savings rates look decent on paper, inflation erodes real purchasing power. Your number gets bigger. What it can actually buy gets smaller. Wage earners. Wages adjust slowly. Employers don't raise pay the moment inflation ticks up. They wait, negotiate, budget. Meanwhile, the cost of housing, groceries, and insurance moves in near real time. That lag is not a glitch. It's structural. It happens in every single inflationary cycle. Renters. Here's the mechanism that hurts the most people and gets talked about the least. When institutional money floods into real estate because it's cheap to borrow, it competes directly with regular families trying to buy a first home. Prices get bid up beyond what a median wage can support. Would-be buyers get pushed back into renting. Rental demand rises. Rents rise. The renter pays more, builds no equity, and has no asset to benefit when prices eventually climb again. It's a closed loop. Cheap money helps the asset owner buy more assets. Buying more assets raises the price of the assets everyone else needs just to live. The gap widens on both ends at once. This is why recessions in the modern era don't reset inequality. They accelerate it. Part 6. Why this isn't accidental. You might be thinking, surely this is just an unfortunate side effect, not a plan. Here's the more uncomfortable version of the truth. The Fed's official mandate is to manage inflation and maximize employment. It is not tasked with managing wealth inequality. That's simply not in its job description. So when the Fed acts to stabilize the economy, it is optimizing for GDP, employment numbers, and financial system stability, not for whether a 32-year-old renter in Ohio can eventually afford a house. The outcome we're describing isn't a conspiracy where someone sits in a room plotting to keep you poor. It's something arguably more unsettling. It's a rational institution doing exactly its job, in a system where doing that job predictably and repeatedly benefits asset owners over wage earners. Intent doesn't matter here. The pattern is the same every cycle, whether anyone intended it or not. Part 7. What you can actually do. I'm not here to give you financial advice, and I'm not going to pretend there's a magic trick that undoes decades of structural policy. But there are directions worth understanding. 1. Assets, not just cash. Historically, the people who come out ahead of these cycles are the ones holding something: a home, index funds, a small business, even partial ownership in something productive, rather than sitting entirely in cash. That doesn't mean going all in recklessly. It means understanding that cash alone tends to lose ground during these cycles. 2. Pay attention to what the Fed actually does, not just what it says. Rate decisions, balance sheet changes, and language shifts in Fed statements tend to move markets before the average person even hears about it on the news. You don't need to predict every move. You just need to stop being the last to know. 3. Understand your own exposure. Are you a renter in a market where institutional buyers are active? Are you holding most of your net worth in cash while inflation runs above your savings rate? Knowing where you stand in this system is the first step to doing anything about it. The goal isn't to beat the federal. It's to stop being the group the system is designed to move value away from. So here's my question for you. Drop a comment. Do you currently own any assets, or is your money sitting mostly in cash? The next recession isn't a mystery. The mechanism has already played out twice this century. The only question left is which side of it you're going to be on. See you in the next one.